Welcome to our exploration of how economic systems play a crucial role in shaping global trade policies. Economic systems, whether capitalist, socialist, or mixed, provide the foundational rules and structures that guide how countries interact with one another in the global marketplace. These systems influence everything from the flow of goods and services to the regulations that govern international transactions. Understanding the basics of economic systems is essential for grasping why global trade policies differ so much from one country to another. In this video, we'll break down these systems and see how they impact the world's trading landscape. Economic system is essentially the way a society organizes the production, distribution, and consumption of goods and services. It determines who owns resources, how decisions are made, and what role the government plays in economic life. The main types include capitalism, socialism, and mixed economies. Each system has its own approach to managing resources and setting priorities, which in turn affects how countries engage in trade. By understanding these differences, we can better appreciate the diversity of global trade policies. Capitalist economies emphasize private ownership and free markets. In these systems, individuals and businesses make most economic decisions, and the government's role is often limited. This leads to trade policies that favor open markets, minimal restrictions, and competition. Countries like the United States and the United Kingdom typically support free trade agreements and lower tariffs, aiming to maximize efficiency and consumer choice. The capitalist approach has shaped many of the world's major trade organizations and agreements. In contrast, socialist economies prioritize public ownership and government control over key resources. Trade policies in socialist countries often reflect a desire to protect domestic industries and ensure equitable distribution of wealth. This can mean higher tariffs, import quotas, and more state involvement in trade negotiations. Countries with socialist systems may be more cautious about opening their markets, focusing instead on self-sufficiency and social welfare. These priorities shape their unique approach to global trade. Most countries today operate under mixed economic systems, blending elements of capitalism and socialism. These systems allow for both private enterprise and government intervention. Trade policies in mixed economies are often a balancing act, encouraging international trade while also protecting certain industries or social interests. For example, the European Union combines open markets with regulations that support labor rights and environmental standards. This hybrid approach aims to capture the benefits of both systems. Trade policies are the rules and regulations that countries use to manage their international economic relationships. These policies include tariffs, quotas, trade agreements, and standards for products and services. The structure of a country's economic system directly influences how these policies are created and enforced. For example, a capitalist country may push for fewer barriers, while a socialist country may prioritize domestic stability over international competition. Tariffs and quotas are common tools used in trade policy. Tariffs are taxes on imported goods, while quotas limit the amount of a product that can be imported. The choice to use these tools often depends on a country's economic system. Capitalist countries may reduce tariffs to encourage trade, while socialist or mixed economies may use them to protect local industries. These decisions can have a significant impact on global trade flow. Trade agreements are formal arrangements between countries to facilitate trade. These agreements can lower barriers, set common standards, and create new opportunities for businesses. The nature of a country's economic system shapes the kind of agreements it seeks. Capitalist countries often pursue broad multilateral agreements, while socialist countries may prefer bilateral deals that offer more control. Mixed economies might seek a combination of both, reflecting their diverse priorities. Regulatory standards are another key aspect of trade policy. These include rules about product safety, labor conditions, and environmental protection. Countries with different economic systems set these standards based on their values and priorities. For example, mixed economies like those in the EU often have strict regulations to protect consumers and workers, while purely capitalist countries may focus more on efficiency and cost reduction. Globalization has increased the interconnectedness of economies, making trade policies more important than ever. Economic systems must adapt to the realities of a global marketplace, balancing national interests with international cooperation. This has led to the creation of organizations like the World Trade Organization, which helps set rules for global commerce. The way countries respond to globalization depends largely on their economic systems and policy goals. Let's look at the United States as an example. With its capitalist system, the U.S. has historically promoted free trade and open markets. Its trade policies often focus on reducing barriers and expanding access for American businesses. However, recent years have seen debates about protecting domestic industries and jobs, showing that even capitalist countries adjust their policies based on changing economic realities. China provides a different perspective. With a socialist market economy, China's trade policies blend state control with market mechanisms. The government plays a major role in guiding trade, protecting strategic industries, and negotiating agreements. This approach has helped China become a global trade powerhouse, but it also leads to unique challenges and tensions with other countries. Developing countries often face different challenges in shaping their trade policies. Their economic systems may be in transition, and they may rely heavily on certain exports or foreign investment. Trade policies in these countries are often designed to promote growth, attract investment, and protect vulnerable sectors. The influence of international organizations and larger economies can also play a significant role in shaping their approach. International organizations like the World Trade Organization, International Monetary Fund, and World Bank play a major role in shaping global trade policies. These organizations set rules, offer guidance, and sometimes mediate disputes between countries. Their influence can encourage countries to adopt certain economic practices, but the impact often depends on each country's economic system and willingness to cooperate. In summary, economic systems are the foundation upon which global trade policies are built. Whether a country leans toward capitalism, socialism, or a mix of both, its approach to trade reflects its values, priorities, and economic realities. As the world becomes more interconnected, understanding these systems is key to navigating the complexities of international trade. By recognizing the influence of economic systems, we gain insight into why global trade policies look the way they do and how they might evolve in the future.